Everyone, and thank you for tuning in. My name is Anthony Palmer, Group Commercial Director for Carrick. I'm joined today by Simona Gambarini, Executive Director at Goldman Sachs Asset Management, and Rob Enslin, a familiar face to you all, Investment Manager from our in-house asset management company, Linked Investment Managers. Simona is a market strategist providing top-down macro and financial highlights and insights, helping clients navigate dynamic markets. And a dynamic market it certainly is. Simona will focus specifically on the Russia-Ukraine invasion, after which Rob will take us through the current market volatility. Most of us have experienced volatility before and will definitely face it again. That is the nature of being invested in markets. And I look forward to hearing both Simona and Rob's views. Simona, the stage is yours.
Thank you, Anthony. I will start by going through what the implications of the current conflict in the Russian-Ukraine region means for economic growth, inflation, and monetary policy. And then I will spell out what it means for the markets, including commodities, which are obviously a key feature here. So in terms of the impact of the Russian-Ukraine conflict on the global economy, this can happen via four key factors. The first one is the direct hit to GDP in the region. The second is trade to the region. The third is tighter financial conditions. And the fourth is lower commodity supply. Now, the first one and the second one, so the direct hit to GDP and to trade in the region is actually quite small. For context, Russia accounts for around 3% of global GDP, while Ukraine accounts for only 0.4%. And their weight in global trade is also low at around 1%. So we should not expect a major impact from a direct hit to GDP and trade. However, tighter financial conditions and lower commodity supply are much bigger factors here that could lead to substantially lower growth. Now, the impact from tighter condition, as I said, is somewhat bigger. Tightening in financial condition observed prior to the onset of the Russia-Ukraine conflict on the back of the monetary expectations for monetary tightening is already expected to amount to about 140 basis points drag on US GDP and 150 basis point drag on European growth. So a further tightening caused by the Russia-Ukraine situation could pull growth below trend, particularly in Europe. As a reminder, prior to this crisis, we expected global GDP growth of around 4.3% in 2022 against a potential GDP growth, so a trend GDP growth of around 3.5–3%. So our expectations coming into the crisis were of very strong GDP growth, even though the growth was slowing compared to 2021. Now, this crisis could potentially change those assumptions, as I said. And the main drivers of those changes are, as I explained, tighter financial conditions, which were already tightening coming into the crisis and could be tightened further in the next few months, depending on how long this conflict drags on and how bad of an impact it will have. The fourth channel that I explained at the beginning was lower commodity production. Why are we talking about this? Well, Russia accounts for 11% of global oil production, 6% of global gas exports, around 10% of aluminium and nickel production, 40% of palladium production. And together with Ukraine, they account for about 25% of wheat production. So Russia and Ukraine matter a lot for commodities. And we are all very much reliant on commodities for GDP growth. And therefore, that could have a very big impact on economic growth at a global level. In this respect, Europe is the most vulnerable due to its dependency on gas from Russia, for which there is very little substitution. About 40% of Europe's gas comes from Russia, Already, the dependency from Russia had decreased since September, when energy prices started to rise and Russia started to curtail export to Europe, but they still import about 20% of their gas from Russia. So big impact there. At the moment, oil and gas industries and commodities more generally have been carved out from the current package of sanctions. But a significant gas supply disruption to Europe, either because the Western world decides to sanction directly Russian commodity producers, or because Putin orders a stop to exports to punish Europe in retaliation for sanctions, would have a big impact on European growth and inflation, and could even lead to a recession in the area. As a rule of thumb, a 20% rise, for example, in oil prices would add about 13 basis points to global core inflation and 24 basis points to global headline inflation, while reducing growth by about 0.25 percentage points. So overall, we place the odds of a stagflation scenario at around 50% at this point of the conflict, assuming it doesn't get resolved imminently and oil prices remain in the $100, $120 per barrel range for a prolonged period of time. And in this respect, as I said, the Eurozone is especially exposed given its dependence on Russian gas and oil from, for its production and for heating purposes. But we still think that a recession at this point in time is unlikely, and we place the odds at around 20 to 25% of this scenario. So this is more or less where we are at in terms of global growth. In terms of implications for monetary policies, well, we think they're mixed in the sense that we don't expect this to have much of an impact, this conflict to have so much of an impact on US GDP growth. And therefore, we think that the Fed will still go ahead and hike in a couple of weeks' time. But we think that the odds of a 50 basis points hike in March have decreased. We still expect, however, 6 25 basis points hikes by the Fed in 2022. And we think that this is because the US economy is less impacted by the current conflict, and therefore the focus of the Fed will remain very much on inflation, which obviously it's exacerbated by the current crisis. When it comes to the Eurozone, however, the balance between growth and inflation it's much more skewed towards slower growth, to the point that the Eurozone could even end up in a recession as a result of this conflict. Therefore, we think that the ECB will act with caution and might even delay any normalization of monetary policy. We previously expected that the ECB would announce in March already, an end to the QE purchases. We now think that this will be delayed because we doubt they will want to commit to something specifically at the time that is so uncertain for many reasons. And we think that they will only hike in mid-2023 now because of the potential negative impact on growth from a prolonged Russian-Ukraine conflict that leads to substantially higher commodity prices. So very mixed implications for monetary policy. The implication for inflation, at the very least in the short term, is highly inflationary, this episode. The rallying commodity prices, the pressure it would put if we were to not being able to access Russian supply for commodities, it's just exacerbating an already very dramatic picture for inflation. In the longer term, the impact might be less clear-cut in the sense that slower growth will actually prove probably a bit deflationary. But in the short term, there is no uncertainty as to the fact that the conflict will prove inflationary. Now, getting to the market implications of all of this, we've seen obviously as a result of the escalation of the conflict, we have seen high quality fixed income rallying, commodities pushing higher, equity volatility spiking, and equity markets generally being risk off. History suggests that markets tend to recoup the losses as geopolitical risks pass. So we did an analysis looking at geopolitical risks and events since the 1970s, and you will see that 6 months after the event, markets tend to be higher. So we would anyway advise investors to remain invested at this point in time, to not try to trade geopolitical events because it's very, very difficult to time them. And in terms of our asset allocation, I would like to specify that we still see this an opportunity to look to hedge risks selectively to our portfolio allocation. So our portfolios are positioned around neutral, but we still prefer equities and commodities over credit and rates. And we're still looking at this as an opportunity to hedge risk once the volatility in the market has settled a little bit. On the equity front, aside from the obvious implication for the Russian stock market, that Russia risks to be kicked out of key benchmarks like the MSCI due to the lack of liquidity. The biggest impact is in Eurozone equities. And the reason is those are very much exposed to the energy crisis, in the sense that Eurozone equities don't have a very big weight in energy stocks, but they have a big weight in stocks that are subject to higher costs as a result of the energy crisis. So we have revised down a little bit our forecast for the stock 600 and the stock 50, but we have revised up our forecast for the FTSE 100 because similarly, the FTSE, well, oppositely, actually, the FTSE 100 has a lot of weight in energy stocks and much lower weights in stocks that are suffering from higher energy crisis. When it comes to commodities, we still have a forecast for oil prices at around $105 per barrel in 12 months' time. But we see substantial upside risks in the short term. We would not be surprised if oil traded at around 120 to 140 in the next few months. And there isn't very much that can alleviate that pressure. To give you an idea, Russia exports about 7 million barrels of oil per day. The US administration is coordinating and has just announced the release of 60 million barrels of oil per day through the strategic petroleum reserves. But that will only alleviate the pressure from zero export from Russia for about 10 days. And so that's not very much for the oil market, certainly not enough to rebalance the oil market. Other two options for oil to alleviate the pressure on oil prices would be a return of Iran, but that would only add about 1 million barrels per day, so still not enough to offset the loss of 7 million barrels per day from Russia should the worst happen. And the other option would be for OPEC to increase production, but they are already struggling to keep production as it is. And Iraq at the moment is suffering from outages that are taking away about 0.5 million barrels per day. So again, all those options are very far-fetched. The reality is that probably the only way that the oil market can rebalance itself is through demand destruction. And in order for that to happen, prices need to be substantially higher. In fixed income market, and then I will conclude, we have not made major changes to our rates exposure due to geopolitical developments beyond closing our underweight exposure to European real rates. The risks to sovereign bond yields are somewhat two-sided. On the one hand, front yields could continue to decline, as markets recalibrate the degree of near-term tightening that central banks will deliver. But on the other hand, front yields could actually remain stable and rise a little bit further, given an intensification of upside risks to inflation. In effects, obviously, we are underweight the ruble and all the European, Central Eastern European currencies. We are overweight oil producers and safe havens. And our credit allocation remains very much unchanged for now. The most important point that, again, I would stress is that markets tend to recover fairly quickly from those types of events, and that trading geopolitical events is extremely difficult. So we advise clients to remain invested, particularly if your investment horizon is longer than just a couple of months.
All right, perfect. Thanks, Simona. You covered a hell of a lot in a very, very short amount of time, but it was very concise and insightful. Thank you very, very much for your time. As discussed, you can feel free to leave if needs be. I know that you're dealing with tube strikes in London, and I'm sure you've got many, many clients asking for your opinion. So thank you very much. We're going to move over now to Rob, who's going to talk to us about market volatility, historically, as well as what we can expect going forward. So Rob, over to you.
Yes, thanks very much, Ant, and thank you for Simona for those valuable insights. Certainly, as an investment team looking after clients' money on this call, these types of discussions are important to us, and balancing sort of short-term noise against long-term economic trends and opportunities is at the heart of what we do. So what I've really prepared is just a presentation to take us through some previous events of market volatility and provide some sort of clarity and hopefully some comfort as how to respond in these types of events. So I think, as Simona alluded to, we've certainly started off 2022 in a far sort of tougher environment compared to the last couple of years prior to this. And just to provide some context as where we stand today, year to date, updated the slide as of last night's market closes. The NASDAQ is down around 14% year to date, the DAX down 12%, Eurostoxx 50 down 12%, the CAC representing France down about 11%, the S&P 500 10. Sort of maybe two standouts there is that the FTSE is just marginally down by 1%, so relatively speaking, holding up a lot better. And that was alluded to by the fact that the FTSE has a lot more oil-related and energy-related type businesses on their stock exchange. And then lo and behold, our small South African stock market that's been through quite a lot over the last decade, but certainly been a net beneficiary over this period of higher commodity prices and is actually up 5% year to date. So I think let's jump into what is behind the market move. So yes, absolutely, the Russian-Ukrainian geopolitical tensions that are all over the headlines right now has created a lot more uncertainty in the market. It's questioned what inflation looks like. It's questioned what growth may look like in the next 12 months. But coupled with the geopolitical tensions that we're currently experiencing, behind that has also been quite a pivotal change by central banks over the last sort of 6 months. So to provide some context to what I'm saying is when we were sitting as market participants in September, the expectation based on the communication we were getting from central banks was that inflation was likely to be transitory, i.e. level off towards the second half of the year. And as a result, the market's expectation was that central banks like the Federal Reserve were unlikely to aggressively hike interest rates. And just to sort of put a number on that, at the 1st of October last year, the market's expectation for 2022 rate hikes was 1 interest rate hike. In December, the Fed released their minutes from their meeting, and in their meeting, they portrayed a far more hawkish stance towards inflation and therefore interest rate outlook for 2022. And the market was very quick to price in a lot more interest rate hikes. At that point in time, we quickly moved from 1 interest rate hike to 3 interest rate hikes. And then following the Fed's meeting in January, that quickly became 4. Where we stand today, we've really moved on even further. The likes of Goldman's, for example, explaining 6 interest rate hike expectations for this year. Really, all that's changed is that the geopolitical tensions that we're seeing now has reduced the probability of the Fed hiking interest rates by 50 basis points on the 16th of March, and now we're pricing in 25 basis points hikes. But at the heart of that, there's been this increased interest rate hurdle, i.e. an increase in the discount factor, which has been a large contributor towards markets selling off in the first half of this year, which has been far more pronounced in high growth business models as opposed to value oriented business models. So we've created a backdrop that is certainly uncertain and does create quite a lot of fear. And as investors sitting on this call, I'm sure you're questioning what to do from here and whether we should panic. And I think first and foremost, just to provide some context, if we look at markets over extended periods of time, and we're looking here at the S&P 500 since the financial crisis back in 2008, which ended early 2009, there's been numerous events that have taken place through the last decade or so that have been reasons to sell out of your portfolio. But probably the most sensible approach over this entire period was to remain invested. And I think this time is no different. Certainly each event is unique and has unique challenges and understandings, but the most successful strategy for clients has been to remain invested. If you were that very talented, which we don't believe exists, investor who was able to sort of get in and out of each time of these opportunities, sure, one could argue that you would have had slightly better returns than this. But the point I want to take away from this slide is that investing, as Ant mentioned in his introduction call, is inherently a risk-taking exercise, and staying the course is probably your most powerful tool as a client. Similarly, with regards to geopolitical events, whilst in the moment they are certainly quite disconcerting and uncomfortable for clients, but really if we refer back to history, and I do appreciate that each event is unique, but as an average, geopolitical tensions tend to be quite sharp and shallow with regards to the sell-off and the recovery. So if we look at the last 22 odd events that have happened in the markets post-World War, we'll see that the average drawdown by the S&P 500 has been 4.6%. And what is also interesting to mention is that that drawdown has been quite sharp. It's taken just 19.7 days for that 4.6% pullback to take place. And the recovery thereafter has equally been quite quick, so 43.2 days. So what we're really saying is that to try and perfectly time your exit and your re-entry into the market based on geopolitical events has historically been very hard because of the short timeline that we're dealing with. Secondly, if we look at markets over the last 40 odd years, again, looking at the S&P 500, unfortunately, drawdowns are part and parcel of investing in growth assets like equities. Over the last 40 years, the chart looks at what the annualized return has been for the S&P 500, represented by the blue bars. But equally, during that year, what was its low point, represented by the green bars? And almost without fail, the market somewhere during that year has gone into a drawdown, in many cases in the region of 5 to 10%. So I said, unfortunately, but equally for an active manager, this does provide opportunities to identify mispriced securities and asset classes and to bring that into your portfolio. If we just zone in a little bit closer and just look at the last 5 years and really what has transpired, a similar picture emerges. So over the last 5 years, there's been 5 periods where the market has drawn down, or 4 periods, and the fifth being the one now, where the market has drawn down by 10% or more. That happened back in 2018, 2019. The pandemic, I think, is all fresh in our memories, where the market at one point was down north of 30%. And then again, what we're witnessing right now with the Russian-Ukrainian drawdown, which has been in the region of, dependent on the market you're looking at, between 8 to 12%. However, important to remember, and just as alluded to by our previous caller, is that an important backdrop is to understand how quickly the market recovers post these types of events. And if we look at various examples of where the market has been down between 10 and 20% since the 1970s, one can see that on average, the market has pulled back 14.5%, but subsequently the recovery has been quite, over the last 6 months thereafter, has been short and sharp, where the market has responded 17.4%. So really important takeaway from this is that as a current investor that is invested, crystallizing your losses right now, often more than not, has turned out to be a very poor outcome. And equally for new investors looking to enter the market, although it may feel very uncomfortable entering the market in this environment, historically speaking, this has actually been a very attractive entry point into markets 6 months later. And then just to add some more color to what I've just mentioned, in terms of the average time the recovery has taken over all of those events, if we average it out, it's typically around 4 months for that recovery to almost return back to the loss that one would have realized in that drawdown. As you can see in the chart, the longest has been 9 months and the shortest has been a mere 1 month recovery. The backdrop and the headlines have certainly focused a lot about inflation over the last couple of months. And to some degree, there's this misunderstanding by certain investors that inflation is bad for markets per se. And if we look at examples of when the Fed has hiked interest rates and how various asset classes have responded, there are some clear opportunities in a rate hiking cycle. If we look at commodities, commodities have achieved an annualized return of around 19% per year in Fed rate hiking cycles. Emerging markets around 16%, Japan 14%, gold 11%, Europe 10%. And I think the geopolitical tensions that we're seeing right now have obviously changed the short-term outlook for Europe in particular. But nevertheless, over extended periods, we've achieved that 10%. And the S&P 500 doing around 8%. Your classic balanced portfolio that holds around 60% in equities and 40% in bond-like instruments has achieved a return of around 5% historically speaking. Also thought it was important just to include the slide, and the slide is as at the end of 2021 as we stepped into 2022, and to look at market valuations and across various regions. And I think there's a few takeaways from the slide. First and foremost, generally speaking, most markets were looking a lot cheaper than what they were looking like back a year prior to that, so in December 2020. So December 2020 is represented by the PE multiple of that particular market at that point in time, and the blue diamond represents what the market looked like at the beginning of this year. So you can see across the board, markets have generally derated or become a little cheaper. And a big function of that is that company earnings have come through relatively stronger compared to the price appreciation of the prior year. Secondly, most markets are actually a lot closer to a fair value multiple. So to explain this chart a bit further, the black bars represents the highest that multiple has been, and the bottom end of the bar represents the cheapest that market has been over the last since 1995, so 26 odd years. And you can see, generally speaking, relative to its history, most markets, in particular emerging markets, have looked pretty well priced. The standout being the US. The US in absolute terms and relative to other markets going into 2021 was looking a lot more expensive, does partially explain why the first part of January and February before the geopolitical tensions emerged, why the US was relatively underperforming the likes of Europe, the FTSE and Japan. As alluded to on the previous call, the tensions of Russia does certainly lean in favor of the US, given its positioning in the market for the next 12 months. So with that, I just want to touch on sort of final thoughts with this backdrop and everything that we've covered. In terms of Linked as a business, we're certainly not rushed to make portfolio adjustments at this stage, as we expect ongoing bouts of volatility, both on asset classes, regions, and even equity styles. And therefore, we rather prefer to sort of sit back, take a strategic view, understand what direction economic growth is likely to take, where valuations are at, how central banks are likely to respond, and use this as an opportunity to take advantage of it in the portfolios that we manage on your behalf. We are certainly, with that being said, we're not naive to the importance of being close to what is transpiring, and we are closely monitoring various asset classes and where those opportunities lie, and how the tensions within the Ukraine and Russia sort of emerge from what we already know in the markets. And as a final piece, what I think is valuable for clients' do's and don't do's in this type of environment is, first and foremost, I think we do need to expect volatility to remain in markets for the first half of this year. Secondly, don't try and time the markets. This is a statistically proven poor strategy. I think there's numerous examples that I've just taken you through where crystallizing a loss in market volatility has been detrimental to your performance. Also think it's a good time to re-engage with your financial advisor. Ensure that you are in the appropriate investment strategy relative to your risk profile. In times like this, if you're overly exposed to risk, you'll certainly be from a comfort level will be heightened and therefore often drive poor investment decision makings. Avoid short-termism. We are in a very fluid market as we speak, lots of changing information on a daily basis. And if one is going to focus on the short-term news and try and adopt those to your long-term financial goals, more than likely you're going to change course for the wrong reasons. Equally, with a rising rate in cycle that we're moving into, whether it be from the Fed or the ECB, it's important to remain well diversified across the asset classes, sectors, and investment styles. We would strongly encourage clients to avoid market fads. We've been in a highly accommodative environment for the last decade where certain asset classes have been able to thrive and grow because the cost of debt has been so low. As interest rates rise, some of those investments that have often been sounded good come under a lot more pressure in this type of environment and are prone to almost bubble bursting environments compared to the previous decade that we've been. And then finally, I just think communication is vital in this environment. We have the privilege of having strong financial advisors on the ground. Linked investment managers are here to also provide some feedback and equally link into some of the biggest houses in the world and share their thoughts in our portfolio construction and thinking. So with that, Ant, I just want to thank you for this opportunity and look after yourselves.
Thank you very much, Rob. As always, very, very thought-provoking. I love those slides. And it does make you sit back and analyze it from a more sort of objective perspective and take emotion out of it. So all of you that dialed in, I hope you found today's session as interesting as I did. And thank you again for your time. To summarize what Rob said, as always, please stick to your long-term plans, have a diversified portfolio, and make sure that you are in the correct risk profile solutions, as Rob mentioned. And please engage with your Carrick advisor in all of the above regards. Thank you very, very much and to everyone, and have a great day further.